All right, so with me today, I have Brandon Macdonald, CEO of Fireweed Metals now, before Fireweed Zinc. And also here to talk to me about zinc because the metal has really been on a massive roller coaster with a somewhat of a total gain of like 150% from the bottom in 2020 to the top earlier this year, and it's now down over 30%. So I'm looking forward to learning more about this thesis, but you should also know that this is a private conversation between two people that are just simply on the internet. We're not obligated to have your best interest at heart. And so you should do your own research because this is a discussion that's general and impersonal in nature. So again, you should always do your own analysis. That all said, Brandon, thank you for being here again, sir.
Thanks for having me back.
Oh, absolutely. Last time was fun. Learned a couple of things about the industry. Probably going to have a link to our conversation somewhere in the description of this video. And I guess let's just jump into zinc, and I hope we'll be talking about the moves that I just mentioned in zinc as well. But before that, why don't we start off with a simple overview of the supply and demand dynamics of the market, I guess. So, like, what is zinc? What is it used for? Where does it come from? Where does it go, basically?
Yeah, look, it's a base metal. I think the total market's 13 to 14 million tons of metal a year. The majority of that, the number one dominant use by a huge margin is galvanization. So this is the coating of steel to prevent rusting. There's other uses, chemicals, oxides, fertilizer, etc. But really, when you're talking about zinc, it is absolutely dominated by the galvanizing market. Mine supply reasonably diversified in terms of companies. There's no, you've got big players like Hindustan Zinc and Glencore and Teck and stuff like that, but there's no one that is so heavyweight that can really push the market around. But unlike other base metals, mine supply is very heavily driven by China. So about 30 to 35% of mine supply is China. You contrast that with, I think, nickel and copper are like 5 to 8% or something like that, right? So zinc, there's a huge domestic production of zinc in China. So it's a bit different, and the question in the Chinese mine supply is it quota based? Is it a true competitive market? What do those mines look like? They're not big mines. For example, there's only one mine in China that would be considered a large zinc mine. The rest are small, and it's mostly very, very, very small mines, sort of two guys in a bulldozer sort of scale, from these high grade polymetallic mines. So it's a different market than people might be used to if they focus on like a copper or nickel or something like that.
You mentioned that the majority of the demand comes from galvanizing steel, basically prevent corrosion. Have you looked into zinc's potential for it being used in like battery metals? Because that's something that I read while sort of preparing for this video. Is that something that makes part of your thesis, or is that just a possibility?
No, well, look, it's a reality. You've got zinc flow batteries and zinc air batteries that are absolutely real. They're in commercial testing. They work. They're different use than a lithium ion battery. So the thesis for a zinc battery is large, industrial scale or grid scale storage. They don't have the energy density per kilogram that a lithium ion battery does, or maybe per liter, sort of per unit size, which is critical for vehicle applications. But they do have a very high energy density per dollar, right? Which is what matters on kind of a grid scale. So that's an emerging technology. Some interesting companies actually here in Canada that are doing good work on that. That could be a significant but not hugely disruptive. Like, I don't want to pretend that it's going to double the zinc demand or anything like that. I think there was a bullish estimate a couple of years ago that kind of said an extra 8 million tons demand, I think it was, over the next 10 years, which equates to 800,000. These numbers are I'm making them up, but I think it was this is the right order of magnitude. So maybe pop up something below me, the absolute number. I'll try to get you the article after this. But it was like sort of a 5% increase per year if you average it out over those years. So it's like a 5% bump in any metal demand is pretty significant. And now maybe I've got that wrong. Maybe it's a 2 to 3% bump. Maybe it's an 8% bump, but it was something in that order of magnitude, right? So it would make a difference. Anything that has a tight supply demand balance, even a 1% increase, going from a CAGR of 2% to 4% is a big deal, right?
Of course.
Because it's not so easy to grow supply 4% versus 2%, right? So yeah, there's definitely some emerging uses there that could be very interesting. It's not what we pin our thesis on, right? Like we're not trying to say like, hey, zinc price is going to double again, and suddenly our project is going to work where it didn't work before. We're not playing the zinc price. It's trying to be a little more conservative than that.
Right. But so you mentioned that the demand was at around 13 to 14 million tons. Is that what is supply? Because I think I missed that number here.
Well, supply is slightly less than that because I think there's a small. Well, there is not. In terms of, so there's two things here. So zinc, like most base metals, the mines ship a concentrate, and the concentrate goes to smelters, and smelters produce a metal. Right. So now that 13-ish million tons is the metal demand. Right. So then you have to ask, so how much metal is being supplied? And that's being supplied by smelters and recycling. But if then you have a entirely different supply demand balance related for concentrate. Right. So the smelters buy the concentrate and then produce the metal out of it. So you might find that sometimes you've got lots of smelting capacity and not enough concentrate, which means there's a shortage of metal because we don't have enough concentrate. Sometimes, like now, there's a shortage of smelting capacity. So that is leading to a shortage of concentrate. Or sorry, to a shortage of metal, right?
Right.
So there might actually be surplus concentrate right now, but you don't have enough smelting capacity to deal with it. So you've got a shortage of metal. So you look at LME inventories are being drawn down pretty quickly here. And particularly in specific regions like Europe, extremely low zinc inventories. I mean, zinc inventories in Europe are for all intents and purposes zero. So that's kind of the supply demand balance you have to look at is both metal and concentrate.
All right. Okay. So we have a rough idea of demand about 14. Let's call supply 13. Inventories you see there, for all intents and purposes, they're zero. Yeah. So we might be in a slight supply deficit. So it is getting interesting to me. That's sort of the natural resources that I am interested by are the ones that have an undeniable future demand and a difficult supply side of the story, basically.
Yeah. And
so what is the outlook there?
It's worth qualifying that there's, you talked about, okay, look, the COVID lows for a lot of the metals. You kind of have to almost ignore that because that was a period of, it was extremely short-lived because, everyone panicked, everyone sold everything went down. And then zinc and most metals bounced back reasonably quickly. And a lot of that was on mine disruption because of COVID shutdowns, right? So the same thing that brought it down, brought it back up again. But what's driving, zinc went to an all-time high, I think late last year. And what's driving that is the crisis in Europe, right? So the zinc smelters in Europe rely on Russian gas for the energy and inputs. And when Russian gas is suddenly, or gas period is very expensive or in short supply, it's not economic or feasible for them to produce, smelt zinc there. So that's created, a real issue in Europe where the only smelter in Europe that doesn't rely on Russian gas or indirectly Russian gas is the Leiden smelter in Norway, which is hydropowered. So, you've got, Glencore, Trafigura, et cetera, have shut down smelters in France and Italy and Belgium and Netherlands or something like that too. And so now you've got a huge shortage of smelting capacity in Europe, which means that all the auto manufacturers there, for example, which is a big use of zinc, is galvanizing steel frames in automobiles there. Where are they getting their zinc from, right? Like they don't. There's no metal to be had there. The only warehouses are out, and they're having to import everything from elsewhere. So that the very high zinc prices right now are partially driven by that crisis in Europe. What's the ongoing look for that, right? Does that continue? Some people who are more knowledgeable than I think that the smelting capacity in Europe is just not coming back. It's just, you're hard pressed. Like if you're a German politician or a Belgian or French politician or whatever, you'd be hard pressed to justify restarting heavy industry that relies on Russian gas.
Mm. Right.
That seems like because you're taking fuel. To say you start importing LNG at a greater expense from the US or something like that. Now you're taking fuel that is needed to provide demand for households, or to provide electricity for households, and you're feeding a smelter instead. Yeah, I don't see it, right. So I think there's a structural change in the zinc market right now that's not likely to be rectified anytime soon. But the flip side of that, and I talked about the two supply demand balances, is that if you've got a shortage of smelting capacity, it means you might have an excess of concentrate from mines. So the way that gets dealt with is in the treatment charge, which is what the smelters charge the miners to smelt their concentrate. So treatment charges, I think the last spot I'd heard of was 250 US, which is a pretty high treatment charge. I think it'll go over 300 here, which is a very high treatment charge. So that's kind of the big question, is that the metal price is high doesn't necessarily mean the miners make a lot of money. And so this is the back and forth, the ebb and flow of the power dynamic between the miners and the smelters. Is there a surplus of concentrate, or is there a deficit of concentrate relative to smelting capacity? And then relative to smelting output, is there a supply or is there a surplus or deficit of metal? Right. So there's two kind of things to look at there, and it plays out in the metal price and the treatment charge for concentrate.
So what is this bull thesis built on in your case?
So look, the bull thesis is that the smelting issues right now are going to cause like a continued high metal prices for probably the foreseeable future.
But so the smelters are going to be making all the money and not the miners.
I think it's going to be both, because what's going to happen is the treatment charge, you can imagine if I'm selling say for easy math, a 50% zinc concentrate, and I was selling it at, $3,000 a ton per zinc, so $1,500 worth of zinc in it, and I'm paying a $200 treatment charge, I'm left with $1,300 after. There's also payability issue, but let's ignore that for now. Now metal price goes up to 4,000. Now I'm paid 2,000 minus 300 treatment charge. It's 1,700, right? So even though I'm paying a significantly higher treatment charge, I'm making more money. So there's a possibility that we see this sort of $4,000 zinc metal, which is kind of like about $1.80 a pound for those people who think in price per pound, but a 300 plus, per ton concentrate treatment charge, in which case, both of which are very high, but in which case both the smelters and miners should be making a lot of money. Now, the people caught on the outside, if you've got a surplus of concentrate, the people caught on the outside may be the ones with the least desirable concentrate. So small producers of marginal concentrate, this is low grade, high impurity, etc. concentrate, may struggle to move it in a market like this.
What is the, because we're talking about the prices per ton and per pound. What is the average cost of production globally? Do you have an idea?
Yeah, I mean, I think the average cost is like 90 cents, so like about $2,000 per ton. That's kind of an all-in. I can look it up here if we want to
But
do
so it's much lower than the current price at around 3,100,000 a ton. Oh wow, 3,100, so 3,100 a ton. Um, so there's a big gap there, isn't it? Isn't it challenging to keep the price much higher than its price of production?
It is, assuming that there is capacity that can easily, ramp up, right? So, as you know from anything, um, whether it's a zinc, a copper, a uranium, or whatever, it's just not that easy, right? It's not like there's, like you look at our project, for example, would be a very, very large zinc mine. Yet we cannot just press a button and make it happen today. You have to go through engineering and permitting and construction, et cetera, right? And this is not a market that, despite bull case for many metals, is really favoring capital expenditure on development projects, right? So it's you can't just flick a switch, right? So the question is, how long do prices stay high, and does that stimulate, enough production growth? Um, and for the record, I'm just looking at the cost curve here. It looks like the median is about on a cash cost basis. This is not including sustaining capital. I think is about, what's it say here? 83 cents. So on an all-in sustaining cost, yeah, probably 90 cents is $2,000 is probably the median, right? So like virtually everyone should be making money at these prices. Like everyone should be making money, even the most marginal producers. But that doesn't necessarily stimulate immediate supply. There's not necessarily an immediate supply response.
Right. But isn't it right now a tricky point in time sort of to get into zinc as an investor though? Because it seems like it's an industrial metal. So it's mostly industrial driven demand, but the risk for recession is growing. There's health issues in China, there's rising interest rates, inflation, all these things, many other issues that just make it sound like zinc prices are they're heavily dependent on the macroeconomic setting, and that setting does not look that bright on the first glance. So isn't it like, I mean, it sounds like a tricky
Yeah.
time to be getting into this.
Yeah. Well, I mean, look, that's the case with all base metals, that if we go into a recession, as we've seen in copper coming down quite a bit, the base metals will come down accordingly. Where zinc differs a bit, and I'm not going to say that it's risk free in a recession, because it certainly isn't. It is not at all. But that, look at like what the stimulus that came out of COVID, the $13 trillion globally that governments committed to stimulus. You're talking monetary stimulus, that's just a direct injection of capital. But if you're talking an actual fiscal stimulus, like let's spend money, how do you spend $1 trillion, right? Like there's nowhere to spend it really but infrastructure. If you're a government, you're like, look, I want to put people to work. I want to have a lasting legacy of this spend. How do I spend $1 trillion to get the economy going? It's infrastructure. That's China just announced I think $2 trillion infrastructure spend, and the US $1 trillion. Their Build Back Better, or whatever the hell it was called. So infrastructure means steel and means galvanization and zinc, right? So now that's, again, there's not like you sign the bill and suddenly the bridges are built. There's a long ramp up towards that. But it's definitely, it's a bit different in terms of the direct effect of stimulus affects zinc a bit more than some other base metals, not necessarily all of them. But yeah, look, your point is definitely it's a investor beware sort of time in the market right now, right? It's mining stocks are extraordinarily beat up and look attractive, but a recession is not going to help that, right? It's not going to make it better. The challenge is timing your entry because the longer there's no capex being spent in mining right now. The total capex in mining is still very, very low. It has been since 2012. So if you're not building new mines, you are starving the market of new supply, and you can only do that for so long. You can some mine, Joe Mine can do a bit of a brownfields expansion or try to produce a bit more or high grade or something like that to get a bit more metal out during periods of high prices. But sooner or later, that strategy stops working. And this is the case for copper, for nickel, for zinc, for uranium, for anything. It's like when the market finally flips and commodity prices are up and there's an interest in capital, it still takes the better part of 5 to 10 years for the impact of that capital to be felt in metal supply. So this is the fundamental bull case for base metals is that we've starved the market of capital for 10 years. And the longer you starve the market of capital, the longer you have a bear market, the more pronounced and longer lasting the bull market will be in a response. As they say, the cure for low prices is low prices, and the cure for high prices is high prices, right? So, interestingly enough, and we've had these incredibly high metal prices in the last year or so, certainly zinc, but there's been any major projects that have come online. There's been no supply response to it. So we've missed an opportunity to capitalize on that.
That's true. That's the general case for commodities. That's mostly what attracted me to commodities, and I guess metals more specifically. The development timelines are also it's not getting easier to put a mine into production, and raising capital for a mine these days doesn't seem easy either.
No.
But so if I were to sort of sketch a risk reward scenario here, on the downside, it sounds to me like that $2,000 range is sort of where it could fall to, because that's sort of the price of production. What about on the upside? Because the recent highs were 4,500, so 4,500. That's about 50% upside. Is that could we get back up there, or do you even expect us to go higher than that?
Well, I think higher is a distinct possibility. I think particularly on the physical metal side, because the inventories are so low. And if you get a true global stock out, then the sky's the limit, right? And I think that you've got all this reduction in smelter capacity in Europe, and then you've got there's one of the major, but not the biggest smelter in Korea had a 1 month shutdown for environmental reasons, and that may happen again. And I've heard rumors that it might last longer. And if that happens, then you've starved the market of metal. You've got a real problem. Now, what does that do to miners? The ones on fixed contracts for treatment charges are doing great, right? The ones who are paying a spot market for treatment charges might have a bit of problem because they're going to struggle to find a smelter to take their concentrate. But I think we could see $2.50 or even $3, zinc briefly, if that stock out occurs, if there's that real complete elimination of LME inventory, right? Now, long term, I have a favorite chart I sent to a friend that showed the long term inflation adjusted zinc price, and it showed that what I was paying attention to was the shock levels, the bits that it dropped down to, for COVID and 2008, and there was one in 2015, and I showed that floor, which only ever gets touched briefly, has been increasing faster than inflation, significantly faster. Now you could argue that because the government inflation numbers are bullshit, but whatever the case, I don't see the floor in COVID was $2,000 a ton, about 80 cents, 80-ish cents, 83 cents, I think, per pound. I don't see us hitting that. That strikes me as extraordinarily unlikely. I'm not sure we'll see 2,200 or $1 a pound again. My kind of long-term floor is closer to $1.20, sort of, whatever that is, 2,600 a ton or something like that. So, but it's hard to say what sort of supply or demand disruption occurs.
Mm.
I don't see prices dropping below that more than temporarily. I mean, look, we've had 8 to 10% global inflation the last year, and so you got to kind of take into account, like, that's recalibrate the number you thought about last year. You got to multiply it by 1.1 just to catch up for this year, right?
Mm.
And that's a challenge for us when we think about, we put out an economic study in our project. How do we pick a long-term zinc price, right? Like, how do you pick any long-term metal price? And I don't think it's the job of management to try to predict the prices. A study, whether it's a PEA or pre-feasibility or feasibility study, should kind of reflect, hey, this is what the mine would look like under current conditions, roughly, right? But we'll certainly have, our last study, it used a 121 per pound zinc. That was 2018. I would expect our next study is going to be significantly higher than that.
What do you think needs to happen for zinc to fall lower below that? Like, what is the major risk? Is it because most of these smelters are in Eastern Europe, so I would imagine some type of a larger war scenario might. What would that actually do to the price? I don't know.
They're actually mostly in Western Europe, but they're all shut down anyways, right? So, and not all shut down, but a lot of them are. I think, look, a global economic slowdown that doesn't have a significant infrastructure stimulus response is going to be pretty damaging to the price of zinc. Like all metals, China's a voracious consumer. If they let their economy growth slow substantially or contract, I would think they would have like a revolution in China if the economy contracted. But that's a real risk to the zinc price for sure.
Yeah, it sounds to me like the price is sort of pegged to energy, shipping, and infrastructure growth.
Yeah, that's fair. You've got the of the metal price, you've got the mine costs are part of it, for sure, a big part of it, and then you've got smelting costs, which are energy related, right? Which are a big part of the smelting process. There's not a lot of smelters globally that use like sort of low carbon, low cost energy, like hydropower, right? So Teck's smelter in Trail, British Columbia here, is powered off the BC grid, which is dominantly hydro. Boliden's smelter in Norway, which they're expanding substantially, is hydropowered, right? Other than that, there's not a lot that are, I think CE Zinc in Quebec, would be hydropowered, but there's it's not a lot globally, right? So energy costs are going to affect the metal a lot. But the question is, how much of that does the miner get to take home if the smelter is charging them more for treatment charges?
Exactly. And that's exactly sort of the worrying thoughts that I'm having of, okay, even if I like the thesis, how am I supposed to invest in it? Like, what do I do? Do I buy a smelter? Are there even any publicly listed smelters? Because
independently, I mean, look, smelting has traditionally not been a great business. Weirdly, I mean, I guess you could look at integrated groups. Teck Resources, for example, headquartered here in Vancouver. They have the world's second largest zinc mine at Red Dog. and they also have a big smelter, right? So they both receive treatment charges and pay treatment charges. Boliden as well, has a lot of zinc production, but they also have a big smelting complex, right? And they're not so energy reliant. So you're able to play the metal with both of them, although Boliden and Teck both diversified, so you're not getting pure zinc exposure. But you're able to, both of them, you'd have metal exposure without taking out at least part of the smelter miner power dynamic, if you're concerned that you can't predict that.
Wouldn't it be more prudent to look for a company that does like maybe zinc and aluminum? Because I believe aluminum is a substitute for zinc. And so if you're in a pure play zinc play, but it sort of starts getting substituted by aluminum, wouldn't that be a risk?
I don't know how often zinc gets substituted by aluminum for hot dip galvanization. It doesn't. For spray, I don't know of a lot of instances that it does. And certainly I wouldn't, the aluminum price right now is 2,500 per ton, but that doesn't make any sense to me with current energy prices. I don't know which smelters are making money at that price, because aluminum is even more energy intensive than zinc smelting. That is a super, super, super energy intensive process, right? So yeah, and I don't know if there are any zinc aluminum companies. I personally, my general thesis, and it's not that I'm any sort of investing wizard. And I think we said in our last call, I make most of my money investing because I get access to good deals. But I try to own a copper company, a nickel company, a zinc. Well, I own a lot of a zinc company, so I don't own any other ones. People ask me what other zinc companies I invest in, and the answer is none. Right? I have got all the exposure there I could possibly want. But I think some diversification and weight it heavily, or not heavily, but more heavily towards the metals that you're most bullish on. When I see people whose mining portfolios are 80% copper or 70% uranium or something like that, it's like, that's like, it's a lot of eggs in one basket. I mean, I
that's
get
me.
Yeah. I mean, I get that. If you over diversify, you're running a beta fund, right? You have no alpha. So you have to make bets. I'm always reluctant to bet too heavily on one commodity. But I think of like I think it's Joe Mazumdar and Brent Cook of Exploration Insights. Their MO has always been be relatively commodity agnostic, not fully commodity agnostic, but relatively, and try to pick companies whose project would be in the lower half of the cost curve, because that's a good project, right? That's one that gets built regardless.
They even say like lower quartile, so the lowest 25% basically. But that's tough to find, especially in zinc, right?
Yeah, and I think about who is in the lowest quartile here, like looking at they're pretty rare projects, right? Even Teck's Red Dog is well, that's unfair. Teck's Red Dog is not in the lower quartile because they pay so much on royalty. But that's kind of bullshit, because the royalty is a profit interest, so it's not fixed. So if the price of zinc comes down, the royalty comes down, right? So the royalty is never going to put them to the point they're losing money.
Yeah.
Because if they're losing money, they're not making a profit. If they're not making a profit, there's no profit to share. So royalties are a bit weird, because where they are on the cost curve would vary depending on the price of zinc.
Right. What I sort of have challenges with commodities like zinc, if you're looking for lower quartile producers, is that oftentimes obviously all the other rules of investing still apply. Like you got to have the management, you got to have good jurisdiction, and all the other things apply, and you got to have them in the lowest quartile. And oftentimes the package is just not complete. Like it would have them in the lower quartile, but like they would be missing some main things, like the people or whatever it might be.
More or
So I
less
find that to be a challenge.
dubious jurisdiction or something like that, right?
Exactly.
So that's and look, I've always said that there's not a lot of money to be made to be invested in 5-star assets, because when it's a 5-star asset, it's should be fully priced. Everyone should recognize that that's a 5-star asset. What you tend to, unless you get in before that's apparent, like an expiration victory or something like that, right? So, but what I tend to look for is assets that I think are 3 or 4-star that are priced like they're 1 to 3-star, because someone misunderstands the risks. That's what you're looking for. Someone says, "Oh, that jurisdiction is impossible," but like, actually, no, it's not. It's not. It's like it's a fine jurisdiction. It takes to take some time or whatever, or their grade is too low. It's like, well, maybe it's not if it's got scale, then it's got easy processing or something like that, right? So that's where you have an edge as an investor, is if you can spot an asset that's a 4-star asset, but is priced like it's 2-star because it's misunderstood, right? That's what you're looking for. And just going out to the market and saying, I'm going to buy the best zinc companies. It's like, okay, yeah, look, that's fine, but do you have much alpha to the company at that point? That's the question. I get it. Like as you start to pick up projects that have more warts on them, it gets riskier, right?
Exactly. Right. And it is also, I guess this is sort of falls in the same category of challenges, is that a company would, like, there's not many pure play zinc companies, right? I don't know of many companies. You used to think that you're going to be one, but your story changed, and that's why you also changed the name.
Yeah.
So that's one of the challenges too, because you have to take all the other metals, whether you like them or not, and the share price of your company is going to be influenced by the movements in the other metals as well.
Yeah, and I would argue that anyone who is pre-production is probably significantly more levered to market sentiment in the junior space than they are the metal price. In fact, they may almost be unpegged in many respects to the metal prices. Zinc went up crazy last year and we didn't move, right? It's still very high and we're not getting any love for that because the sentiment's so low. The companies that, if you really wanted pure play exposure to zinc, you're looking for a producer that is zinc heavy, maybe zinc dominant, that doesn't need to go to the capital markets, right? You're not facing dilution. So you can, if they're beat up because the market sentiment sucks, that at least you're getting good dividend yield or good free cash flow per share or something like that, right? And there wasn't a lot of those. The only kind of like near pure play zinc producer is Trevali. I'd say was, that's not fair. They've really suffered. Their mines are reaching end of mine life. They had to shut one down. They had that tragic accident in their mine in Africa. So that's been a difficult story, right? Despite the fact that zinc prices are incredibly high, your pure play junior zinc producer has not done well at all.
I'm sort of failing to see that leverage though, because it sounds to me on first glance, I haven't looked into this too much, but it sounds to me like the risk reward on physical zinc might even be better than on these companies, because you don't even know if your company is going to be making the money if the zinc price goes up, because it could end up being the situation that you previously explained, in which the smelters, for example, make the money and not your company. Is that like this physical zinc come into your thesis anywhere?
No, I mean, physical base metals are a tough play because your cost of carry, which is your warehousing cost, your insurance, your financing costs, ends up being a significant drain on a monthly basis, right?
Mm-hmm.
gold is very easy to own physically because the cost of storage is relatively very low per unit value, because like $400,000 worth of gold is this big, right?
For all intent, for all the purposes that you're talking to me, like it's absolutely zero to store gold under my mattress. So
yeah. But even in a warehouse insured, it's very low, right? Whereas that much zinc is like $30. I don't know. It's something like that. It's not much, right? So you store it in LME warehouse, and I don't know what the LME warehouse fees are right now, but I think it's like 50 cents. Warehouse
50 cents per pound,
per ton per day.
Oh, okay, yeah, per day. Wow.
Yeah. This is what I mean. Like it is not cheap to hold metal on warrant in the LME. Now you can take it off warrant. You can go to the warehousing company and you can say, basically take it off warrant. Like as in the metal may not even move, but they literally just take it out of the LME system and charge you. Yeah, here we go. Zinc 53 to 54 cents per ton per day. So 48 to 54. Depending on where you are. So look, you might be able to convince them to move it outside because zinc doesn't rust. So let's move all my zinc ingots to a concrete pad outside the warehouse, so it's cheaper. But then you're spending a certain amount per ton to move it outside, so you better hold it for at least a little bit amount of time. And I still think even out in the concrete pad, you're probably not going to get cheaper than 20 cents per ton per day. So this adds up, right? That's an expensive trade to sit on physical zinc.
What about some of the physical ETFs? I'm looking at one right now. I think Wisdom Tree has one. Is that an option?
Oh yeah, could be.
They do have ETFs, but is that like a option that you would consider?
No, but this is also me being a miner and wanting to leverage my skill sets to the margins on physical metal trading are pretty slim. So when I was actually a banker and working in metals trading in London, we did a sort of cash and carry trade. And the carry trade is to buy metal. In that case, it was aluminum. So we were buying aluminum and selling it forward, and there was a contango. So I could buy it for $1,500 a ton, sell it for $1,600 a ton a year out. But my cost to hold it for a year was $70. So I made $30 per year. Now, it was actually tighter than that. It seems like, okay, that doesn't seem like a very good trade. But if I'm buying it and selling it forward, the price is guaranteed. It's locked in. My counterparty is the London clearinghouse. It is AAA to the AAA. And so I can borrow against that. So you borrow against it. And if you've got very low interest rates, your borrowing costs might be 20 of that $30. But so you're only left with $10, but you're borrowing 95% or something like that, right? So your actual return on capital ends up being very meaningful. So that's a classic. Now those numbers are all wrong. I'm trying to remember what we were actually earning on that. It wasn't a lot, but it was just that the bank had capital. And it's like, how do we deploy a lot of capital and get some modest guaranteed return? And so that was one way we did it, was buying a lot of aluminum. So that tends to be one of the financial, but that was a hedged exposure. Like we had no exposure to the price of aluminum because we forward sold it the day we bought it, the instant we bought it. So there was no forward exposure there whatsoever, no pricing risk.
Okay. Well, this all sounds very complicated to me.
It is very complicated.
No, possibly it's just me, to be honest. But I'm just sitting here and I'm wondering, I've got a portfolio that is gold and silver, uranium, and then some copper as well. And I'm thinking, why would I need zinc if if I don't have the same level of conviction that I do on uranium, where, for example, the spot price is under the price of production and there is an actual rather large supply deficit.
Yeah.
So why would I need it?
Look, it's diversification, right? I mean, for any given investor, I think you have to question, okay, how much do I want to focus my investment? And it's also a case of, like I said, the Exploration Insights mindset, which is be mindful of the commodity, but pick the best projects, right? The case for zinc, medium to long term, whatever the short term noise is not bearish. It is a bull, medium to long term case. If you are parking money, if you're trading, it's very different between trading and investing. If you're trading, then a bull, medium to long term case may not matter to you because you're looking for a maybe 1 month to 12-month trade. But if there's part of your, if you have a large portfolio, you can't actively manage it all. That there's too much going on.
Right.
It's just not possible. So the larger your portfolio is, the more, if you have a small portfolio, if you're young and you're building your wealth, you can probably trade your portfolio pretty easily because you might not have a lot of positions and the positions are not so large that you need to worry about liquidity to trade in or out of them. Right. But if you do have to worry about liquidity and you do have to worry about bandwidth to pay attention to your positions, then you got to think, okay, I need to think medium to long term, because I need to think about how do I get a big position in something that I'm bullish on medium term that I don't need to babysit, right? So that's the question, and I think the one size fits all trading and investing mentality doesn't work, because everyone's needs, risk tolerance, bandwidth, etc., is different. I almost never do what I would consider a trade, like something that I'm expecting to sell out of within 3 to 6 months, because I don't have time to pay attention to it. I'm way too busy. So I tend to look for what I would consider investments that my minimum horizon sort of being 1 year to 2 years is the hope that I don't have to pay attention to it within that time frame.
Right.
But I can feel somewhat comfortable that it's going to go up and down, but I'm strongly believe that in the long term it's going to be up. But if people I know who are trading, and I know I have a chat group of people who seem to be selling their positions the same day they buy them. If they get a quick bounce, and they're paying a lot of attention to technicals and are trading in our positions, and that's a very different mindset and a very different. You pick your positions differently if you're doing that than if you're doing it the way I'm doing it.
Right. And diversification obviously makes sense to me.
Yeah.
Which was the reason why I brought in copper, though. And I'm just thinking, is there a setting, an economic setting that you can think of is there an economic world or whatever that you can think of in which copper doesn't go up, but zinc does, or in which copper crashes, but zinc doesn't? Like, would zinc provide me, would it provide me that much more diversification now that I do have copper in the portfolio?
Yeah, I guess, like opinions will differ here. I mean, the copper has crashed recently.
Yeah.
And I mean, feel free to put a pop-up of my face when you edit this, but I think zinc has come down a lot less, right? So that's a situation of they're not necessarily trading in lockstep. They do have different underlying factors. It was interesting to hear from one of the major trading houses that their two metals they were most bullish were copper and zinc, and for different reasons. Personally, I think the demand case for copper is more bullish than for zinc, for sure. Like I will not argue that case, but I think the supply case for zinc is more bullish. I think the although I would not consider the cupboard, so to speak, for copper to be stocked, there is a lot of low grade porphyries out there that could be developed in the next cycle.
Mm.
Is it enough? I don't know. Are they finding more of them? I mean, Philos had a pretty good run there, but that's not enough. You need a lot of Philos to make up that supply gap. So I'm still bullish copper, and I own copper companies. But to me, the zinc development pipeline is worse. I think it's worse by a good margin.
Okay, now you're starting to get my attention more, because I like store. If I had to really pick, I would give more attention to stories with challenged supply, as opposed to the demand side being very bullish. Just because it seems like the supply is more easily predictable than the demand. I don't know if I'm making any sense, but I sort of have that feel to it. And I was just checking on some numbers while you were speaking. By the way, zinc is actually up year over year about 6%. Copper is down 16% year over year. So I guess kind of a stupid question for me. Would there be an economic setting? Apparently, we are in this economic setting where zinc can go up and copper can go down. Month over month, though, both metals have crashed. So copper's down 19%, zinc's down 20%.
Yeah.
So, but now you're making more sense to me. Like, there seems to be a disconnect there.
I would be a little wary of, zinc's had a very unique problem. I mean, not unique, because it's more than just zinc being affected. Nickel, for example, was affected by the Russian, Ukraine, crisis. But the smelting capacity in Europe for zinc was a huge driver, maybe the driver of the zinc price over the last year. How often will that sort of, event happen? I don't know. Right. I'm not trying to convince you that it's not worth paying attention to, but for me, like, if I was not a zinc CEO, it's like, yes, we are now a polymetallic company. We were before, but we were 60% payable zinc, so we're really a zinc company. Now, zinc and tungsten are the two biggest. If I was not running this company and I was just allocating my portfolio, how much would I put into zinc? First off, let's talk about my mining portfolio, because I would not obviously have 100% of my portfolio in mining, although I do right now, and we can question the wisdom of that. I think that's very fair. Of my mining portfolio, I'd probably be 10 to 20% zinc, right? So there'd be probably, if I owned, say 15 companies, 15 junior to senior mining companies, which maybe even be a lot to follow, but let's call it 10 to 15. I'd probably own one or two that are zinc, and actually be 1 to 3. And it's a possibility that number 2 and 3 would probably be polymetallic, like sort of like an Adriatic, right?
Yeah.
Metals, which is, I think at these zinc and silver prices is more zinc than silver. But I wouldn't really consider them a zinc company necessarily, right? So that's, polymetallic deposits, generally the most common kind that I'd be investing in might be a VMS, something like that, right? So that's copper, zinc, lead, gold, silver, usually.
Right.
So those can be very high grade. Whatever the metallurgy problems, I think they're attractive. So I don't know, that would be picking out a zinc company, but again, it would be, it comes down to what stories am I excited about as well. I think that, like I said, I don't do a lot of commodity based investing. I would try to, it'd be more of avoiding risk concentration than choosing risk diversification for me. So it wouldn't be like I want 10% zinc, 30% copper, 20% nickel, blah, 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 or whatever. It would be like let's look at my portfolio. Am I overweight something? That would be, I'd be paying more attention to, let's make sure I'm not overweight a commodity, as opposed to let me get my commodity mix perfect. Does It's like, no, let me pick companies I like with good projects and good management that I think are undervalued. And if I seem to be over concentrating in one metal, then I will deal with that when I, cross that bridge when I come to it.
Hmm. Okay. Well, yeah, now you're making more sense. Now, when you mentioned the 5 to 10%, is that like in dollar value weight, or is that in the number of companies, or how would you? Because you said that
Same.
few
I think I
companies.
said 10 or yeah, 1 to 2. So yeah, 1 to 3. So that would be a sort of 8 to 20%, depending on how many companies you're running or something like that. But yeah, like I think you look at the big. No, I don't like bulks either. Um, obviously the mining industry is dominated by coals and iron ore and stuff like that. Those are not. It's not that I have anything against them. It's just not an area I necessarily understand. So I wouldn't. I don't think I have a lot of exposure there. Um, and I've never, I don't invest in. That's not true. A reasonable amount of my portfolio is I was gonna say I don't invest specifically, but I do in gold and silver companies. I don't own any silver plays right now, but I do own a couple gold plays,
Hmm.
3 actually. So, but where was I going with this? Yeah, like it would be more that I think if I had over 30% zinc primary exposure, I'd be like, okay, this is time to do a sanity check and whether this is a sensible concentration for a one of the it's a major base metal, but it's a smaller market than a copper, et cetera. Like, should I be this concentrated in zinc?
Hmm.
Um,
I'm just thinking about how I might approach this myself and where it might come into my portfolio. Is that if like I don't have any exposure to it, would you recommend me looking into developers first, or like, because in most commodities that's what people would recommend me, like the pre-production sweet spot, like a lot
yeah,
will call it.
I'm trying to think of who is in the pre-production sweet spot though. I mean, again, like Adriatic, there should be producing, next year half.
Yeah,
Um,
I think it was they're aiming for Q2 2023. I spoke
yeah, and they
spoke to
really have,
Paul.
they're fully financed through production and we're not getting a lot of love. I think that's it's something like that. Trying to avoid naming specific names, but yeah, like I think that it depends on what your comfort level is, right? Like certainly development stage projects in that sweet spot um, are easier in terms of the earlier stage you go, like from production. Production is a cash flow thing, right? Like if you have a basic sense of balance sheets, you
Yeah.
can, like I mean, you understand the economics of production and you can read a financial statements and balance sheet and build your own models, so you'd be very comfortable there. But then you go down to explorers. Now if you're looking at explorers, that is very geological, right?
Mm.
Like you better have some sense of the geology of whether they're on a wild goose chase or not, because I've seen some, it's not just zinc, but I've seen all sorts of explorers claiming to be looking for something in the wrong spot, and maybe they know something I don't, but it turns out they don't, right? Like so
Yeah.
um so you need to understand where your edge is.
Okay.
If you're not, if you're not comfortable with that geology, then exploration is difficult. It becomes more and more of the so-called lottery ticket with about lottery ticket odds, because if you don't have that specific technical know-how, then it's difficult to do an exploration play.
Hmm.
Uh, but if you might back management in that case, right? If you have a strong sense of management, or you might be reading Twitter and reading newsletters and be following other people's guidances. But that's a different beast than trying to pick it yourself, right? So
Yeah, I think that's a completely different type of investing.
Yeah.
Okay, well, I've taken a lot of notes here, Brandon, and you've given me a lot of information. So don't only be fair to ask about your own company. Where do you come on the spectrum? What are you guys doing right now?
Yeah, look, and I'll stick, given the topic of the day, I'll stick to the zinc project we have. And look, it's advanced exploration, early development, right? So we're getting out of that point where a lot of specific geology is needed, and into the point where it becomes a question of, okay, this is looking to be a really big zinc project. I think, and you talked in the initial disclaimer of our talk was, don't really trust anything we say. And so obviously anyone listening, take this with a giant grain of salt, because I am paid to pitch the company. But I think it's one of the best zinc development projects in the world, if not the best. And that's very subjective, and something you can only know with hindsight eventually when it gets built. But there's no, the majors are not doing M&A on base metals right now, or at least just started. And then this current downturn has kind of disrupted that. But when the M&A starts, if you're a major diversified miner and you're looking to add something to your portfolio, and you're thinking zinc, and the zinc market is the zinc majors are getting more bullish zinc, then our project would be high on your list, right? It'd be one you'd absolutely look at. Is it the one you pull a trigger on? I've got a little boy running around here. Is it the project you'd pull the trigger on? Well, let's find out. But it certainly would be on your short list, and that's the exploration insight sort of model that I was talking about. Of let's look at projects that would not be swing producers, that would be big, that could attract a take up from a major. We would be a candidate, right? So
Mhm.
if you're looking for zinc exposure, and you're looking, and you know that you get the most torque in that sort of sweet spot that we're approaching, then I think we'd be on a short list. I'm not saying that we should be the one you choose, or should be amongst the basket you would choose, but if you're looking for zinc exposure and you're not looking at us, I think it's I think you need to reconsider. That's what I would kind of say.
But it's not like the zinc project. That's not something that you want to maybe spin off and see through production yourself.
Um, People have asked us about the spinning off so that we separate the tungsten project from the zinc project. The challenge is that or the opportunity, I should say, is that they're right next to each other, like immediately adjacent. So, which is why we bought it. And if you've got these two projects right next to each other, that there's so many co-development synergies. There's so many opportunities to develop them together, and save a lot of money developing them together. So we don't think it makes sense to spin it out. Now, did someone make a bid for just one of the projects? Maybe. And then we do a spin out, and shareholders own the residual one, right? Own the residual one. So, but for now, we're keeping them together.
Okay, but doesn't that couldn't you make something work where you just have two separate tickers, Fireweed Zinc and Fireweed Tungsten or something like that, and then share some of the costs like between the
Yeah,
two companies, just so you can have a pure play.
yeah, you could, and the joint venture agreement between the two companies would be very complex. And I think in particular the challenge would be that, because the projects are next to each other and you're running it in some sort of joint venture, you're going to go through the permitting process together. So now you've got two proponents on one permitting process. I like I would, if I can crack that nut, we would definitely think about it. Every time we've gotten into the weeds on this, it just comes back to I think we just have to leave them together sort of decision. But yeah, we'll see.
Okay, well, Fireweed Metals, thank you for introducing this to me. I do not know nearly enough about your company to grill you on it, but I do appreciate you sharing the zinc thesis with me. Is there something that you wanted to talk about, but I'm forgetting to ask?
No, I think we covered a lot of ground here, and I think that I didn't come on here to be a raging zinc bull and kind of convince everyone they need zinc in their portfolio. But I think what we talked about, really, that if you're investing in mining, look to be somewhat diversified, and I think there's a strong case to having a company or two in a broader portfolio that have significant zinc exposure, because it is unique in terms of that infrastructure torque and in terms of like the current, crisis in Europe.
All right. All right. Well, Brandon, it sounds to me like your son's ringing the bell, so you can go play.
Yeah. It's right. That's
So.
that's the bell. The interview's over. Yeah, he needs
Exactly. Well, thank you for investing your time with me, sir.
No problem. We'll catch you later.